Good morning. It's Friday, the 27th of September, and this is Govindraj Ethiraj, headquartered in broadcasting and streaming from Mumbai usually. That's India's financial capital, but in transit right now. The Take will be back on Monday with a fresh take, and meanwhile, our top stories and themes for the day. The stock markets are rising, hitting fresh highs, but also diverging within. Oil prices slide as, contrary to expectations, Saudi Arabia and others might hike production. Credit card defaults are rising, and why that is worrying. Indian steel companies want import duties to be doubled. Housing sales are falling, finally, as high prices deter buyers. Why are labor unions striking now and intensifying their demands?
This is the Core Report with Govindraj Ethiraj.
The big divergence in the markets. The stock markets have now hit fresh highs for the sixth consecutive session on Thursday as both metals and auto stocks gained ahead of the rest. The current rally got started after that 50 basis point rate cut from the United States Federal Reserve last Wednesday, and at this point is not showing any signs of stopping. At best, it's taking pauses. With more rate cuts being hinted at by the Federal Reserve, the expectation is that more foreign funds who've been relatively passive in Indian markets could step on the gas. Now, there is that issue of valuations, but then the counter I usually hear is, well, we thought markets were stretched at 70,000 and then 80,000. And now, of course, people are talking about 90,000. It does help the markets that there are no real downsides being anticipated. There is an external geopolitical risk, including of the war in the Middle East right now escalating. But at this point, it's not affecting oil prices, which we will come to shortly. Reuters reported that the auto index in the stock markets jumped about 2.3% to a new high, as well with stocks like Maruti Suzuki, Tata Motors and Mahindra climbing on the back of promises of tax cuts and incentives for their clean mobility efforts. Karnataka is the third largest buyer of electric vehicles in India and has promised a clean mobility tax or taxes and incentives for clean mobility. In July, the Uttar Pradesh government had issued an order waiving the 8 to 10% registration tax on strong and plug-in hybrid cars, which resulted in a reduction on the on-road prices of these cars by up to 4 lakh rupees. Metals are also rising amidst increasing global prices, riding in turn on the China promises of stimulus-driven growth, which the markets, by the way, have not fully bought into. The Sensex was up 666 points to close at 85,836. During trade, it hit a high of 85,930. That's just 70 points, as you can see, short of 86,000. And veteran market analyst G Chokkalingam has already called 90,000 from the Sensex in coming months on the core report earlier this week. So the Nifty 50 also hit an all-time high of 26,250 before ending with a gain of 212 points at 26,216. So the broader indices are wavering now, and the divergence is becoming a little more apparent and visible between the large cap stocks and the rest. Now, this is something to watch closely because it does reflect to some extent who's calling some of the shots and the big moves, and that's obviously the institutional investors. The Nifty mid-cap index was higher, but only by about 0.1%, and the Nifty small-cap 100 index was actually in the red. So you can see now the divergence between the Sensex and the Nifty, which are large caps, and something like the Nifty small-cap index. Meanwhile, in an indication of how things might pan out for the big IT services companies here, as we've been discussing on the core report, IT services company Accenture on Thursday unveiled a $4 billion share buyback and reported better than expected fourth quarter revenue thanks to demand from companies looking to adopt generative artificial intelligence technology. Shares of the company were up nearly 7% in pre-market trading on Thursday, the Business Standard reported. The Dublin-based company reported fourth quarter revenue of about $16.4 billion compared with analysts' expectations of about $16.38 billion, so higher than expectations. And its generative AI business, which helped the company offset the slowdown in demand for IT services, continued to grow for a fourth successive quarter. So the big question, obviously, is how will the Indian IT services company do, particularly in the context of growing generative AI business, and whether they will get a good slice of it. Oil prices are falling despite. Oil prices fell once again after reports emerged that Saudi Arabia was considering increasing output and factions in Libya had reached a deal that opened the way to the returns of increased crude production, according to Bloomberg. So all in all, there's more supply and it's clear who's blinked. Brent crude prices dropped towards $73 a barrel and is now down or are almost down 4% since the close on Tuesday. The Financial Times has reported that Saudi Arabia is ready to abandon its unofficial oil price target of $100 a barrel in a bid to regain market share. So it's an interesting situation because the producers are now likely to increase production, by the way, after threatening to cut back, even as China, the world's largest buyer, shows no signs of pulling in more oil or buying more oil because of its own weak economy and outlook. Bloomberg reported that while oil traders had largely shrugged off China's earlier monetary stimulus measures, President Xi Jinping on Thursday called for the government to provide even more fiscal spending, underscoring the growing anxiety in Beijing over the country's slowing growth. A stronger dollar, by the way, is also affecting commodities like oil. Meanwhile, several nations, including the US, EU, and in the Middle East, have proposed a 3-week ceasefire between Israel and Hezbollah in Lebanon, said Bloomberg. Steelmakers complain again. Indian steel companies have asked the government to double tariffs on steel imports to curb a surge in cheaper steel shipments from China, according to Reuters. India is the world's second biggest crude steel producer, and it became a net importer last year and into the current year as well. Imports from China hit a 7-year high, and overall steel imports have hit a 6-year high. The amounts are small, though, at around 3.7 million tons right now. So the Indian Steel Association, a lobbying body, wants the government to double the customs duty on steel imports to 15%. The body represents major steel producers like Tata Steel, JSW Steel, ArcelorMittal, Nippon Steel India, and the government-owned Steel Authority of India. The ISA said that there was an imminent threat of further surge in imports in the coming months. However, this letter, I must point out, has been written or seems to have been written before the latest stimulus measures by China, which have sent metal prices, including steel, up. The problem in recent months has been that China was manufacturing below cost and dumping elsewhere so as to keep its factories running. But that could change if these stimulus measures hold up. So even if the customs duties have not gone up, the stock prices of Indian steel companies surely have, in anticipation of higher Chinese steel prices spilling over to India. By the way, other countries have also hiked tariffs, and Reuters reported that Japanese and European steelmakers have also sought import curbs. And in the United States, a 25% tariff on Chinese steel takes effect on Friday. Credit card payment delays rise. Indians are delaying repayments on credit cards and personal loans, leading to a rise in delinquencies after months of binging on small-ticket consumption loans, says an insightful article from Mint. Now, this is not a surprise as such because the regulatory responses we've been seeing in the last year, including by the Reserve Bank of India, first drawing attention to the fact that small unsecured loans were growing too fast, and then making them expensive, reflected the knowledge of precisely this data, but obviously earlier. The volume of credit card dues where repayments are delayed by over 90 days has increased 17 basis points year on year to about 1.8% in June, according to data from Credit Bureau TransUnion CIBIL, quoted by Mint. Mint also quoted analysts saying one reason for the rise in credit card delinquencies is because a section of borrowers are exhausting their credit limits and are unable to repay. A Macquarie Capital analyst on Wednesday, also quoted in Mint, specifically singled out young millennials for using the entire limit and directly fully defaulting and turning into a non-performing asset even without revolving the loan, which of course you would use or one could use to pay a part of the dues. Bankers feel while there is a rise in small personal loan delinquencies, it has not reached alarming levels. That is absolutely true, but the problem, of course, is social. Unsecured loans means people are borrowing money to spend as money and not to create an asset. And this again has been alluded to several times by the Reserve Bank in the last year and more. The State Bank of India Chairman C.S. Setty said at an event last week that State Bank of India is one of the largest lenders to non-bank lenders and to microfinance institutions where most of the unsecured lending happens. And it's seen some problems with small value loans of 50,000 rupees to 1 lakh rupees. Actually, a good part of this problem is obviously because of the reckless app-enhanced lending which we've seen, where friction is so low that people often act without thinking, and nothing really slows them down from doing that, which is thinking. Moreover, the kind of borrowers. Reserve Bank of India last month increased the frequency of borrower information to credit information companies or credit bureaus to every fortnight from every month at present. Now, this will be effective only from the 1st of Jan next year. Now, this is where I discovered, by the way, that I could actually borrow several times before even my credit history was established, because apparently borrowers are already doing it. And the fact that the data is taking time to get collated allows people to get away. That's not me saying it. It's the State Bank of India chairman. He also said that someone makes an attempt to lend to him, that's the first-time borrower, and even before his credit history is established, he's already borrowing from multiple lenders. Of course, the banks are saying that they are not the primary source of these small loans, mostly going to folks below 35 years of age. The primary source is non-bank finance companies who represent some 82% of these loans and 31% in value. Now, the thing is that non-bank finance companies obviously mostly borrow from banks. Another analyst told Mint that while the average loan burden was about 5 lakh rupees spread across 4 credit accounts, that has now risen to about 5.6 to 5.7 lakh rupees, and the number of accounts per borrower is rising to 7. This is a clear indicator of credit deepening and the result of over-leveraging of borrowers. Remember, we have no choice but to correlate a few things at one go. One is, of course, the rising speculation in markets. And remember, these are much younger speculators as per the Securities and Exchange Board of India's own studies and reports, and who in turn are losing money hand over fist. And then there is inflation and a gap between aspirations and incomes. All of this is adding up to a deadly cocktail. Housing sales are down. Credit card outstandings might be rising, but housing sales are down, something once again stray pieces of data have suggested or alluded to in recent months. Housing sales have fallen 11% in the July to September period to about 100,000 units in 7 major cities on lower launches and an annual 23% increase in average prices according to real estate consulting firm Anarock. So as prices are rising, sales are falling, which is perhaps good news, and this is also happening in all the major cities, though in different ways. New housing supply has also slowed down in the top 7 cities, down 19%, said Anarock. Anarock is also blaming the slowdown, apart from high prices, on monsoons and that the market is now stabilizing, or perhaps should be stabilizing after its peak hit in January to March 2024. So the good news from all of this is that discounts might be on the way from developers who are likely to make it more attractive for you to buy, assuming, of course, or hoping, of course, that prices come down a little. You have to see the dramatic rise in costs by that 23% figure. It's gone from about 6,800 rupees per square feet in the third quarter of 2023 to almost about 8,400 rupees per square feet in the third quarter of 2024, according to Anarock. Why are labor strikes increasing? Thousands of Indian workers marched through several towns and cities, including Lucknow, New Delhi, and Kolkata, earlier this week, protesting and demanding the repeal of 4 labor codes which they say favor multinational corporations. The labor laws were, of course, introduced about 5 years ago. Reuters reported the national vice president of the All India Trade Union Congress, one of the 10 unions which organized the protests, saying that the labor laws were introduced by the ruling Bharatiya Janata Party in 2019 despite union and opposition objections. Meanwhile, near Chennai, more than 1,000 workers have disrupted operations and protested in a makeshift tent close to Samsung's home appliances factory near the city since September 9th. The Samsung workers want higher wages and union recognition at the plant, which contributes to roughly a third or one-third of Samsung annual revenue of about $12 billion, according to Reuters. So now, to look back, in 2019, the Indian government had replaced some 44 laws with 4 labor codes to establish minimum wages, working conditions, and factory safety standards, though they have yet to be implemented following resistance from worker unions, says Reuters. So what's triggering the protests and why are they picking up steam at this point? And more importantly, what does that portend for industry at large, particularly manufacturing? I reached out to Sabina Dewan, President and Executive Director of JustJobs Network, a research house that focuses on strategies for job creation and workforce development. And I began by asking her what had changed.
The fact that the government took over 44 labor laws and put them into 4 labor codes and has now notified the rules for all 4 of them. This step received both commendation and criticism, but I think most people would agree that reform was long overdue. So in that sense, the fact that we've tried to make the labor laws, streamline them, is a positive step. That said, why these protests are having now, protests are often politically motivated, and I'm not qualified to talk about the politics of the situation, but what I can say is that the soil is really ripe for this kind of collective action, given that our labor market is suffering so much, right? We've got higher levels of informality now. We've got higher levels of self-employment, which means workers are beyond the purview of labor regulations and protections. We've also got really inconsistent regulation, uneven implementation, and varied interpretations because there's so much heterogeneity and the labor codes are not specific enough. And the way that the states are also notifying their own rules is also heterogeneous. And so that's causing a great deal of uncertainty and precarity in the labor market at a time when things are so uncertain and becoming more and more uncertain with technology and climate change that are anyway upending the way people live and work.
Right. So, in the case of the labor laws, what are the specific labor code areas that people are most concerned with at this point?
There's a number of them, right? So we have 4 codes. We have a social security, occupational safety and health, industrial relations, and a code on wages. And I think that, each of them has provisions that are causing concern for workers and trade unions. So, there's several. So, for example, if you take the occupational safety and health code, most workers are left out of its gambit because it mostly applies to companies that have more than 20 employees. And we know that in India, a majority of private enterprises actually have less than 20 employees and therefore are unprotected, right? If you look at the Social Security Code, it's unclear how much of it actually applies to unorganized workers. So the Social Security Code mentions gig workers, but says nothing about part-time workers, for example. So there's a lot of very specific provisions in each of the sort of broad codes. And then, as I said, it's the labor rules are part of the concurrent list of the Constitution's 7th schedule, which means both the center and the state have the power to legislate. So then what the states then do with these central codes is sort of on them. But when companies operate across borders, or you have, for example, platform companies that operate across states, again, the application of the legislation and regulation becomes really difficult to implement. And therefore, workers are left out, not just because they're unorganized or in enterprises less than 20 employees, but also because the law is simply not capturing the reality of today's heterogeneous labor markets.
Let me come to the Samsung case in near Chennai. So the workers there are asking for 2 things from what I can see. One is higher wages, which Samsung says is actually high and higher than the median in that region. And the second is recognition of the union. So how are you reading this?
So I do think that there has been not just in India, but around the world, a weakening of worker voice, right? We have just hyper financialization and capital driven markets. And this has over time weakened worker voice. There's no question, if you look at labor markets in Europe, for example, that have a long tradition of social contracts, the best way for economies to work actually is when you have social dialogue, right? What in international terms is called social dialogue, where you have workers which are represented by strong and vibrant unions. You have employees, so, different kinds of industry federations and so on, and government collectively conversing over these issues. But if workers don't have a voice and they're not at the table, then this kind of sort of capitalistic and hyper financialization it leaves, what should be a 3-sided conversation to be mostly just driven by private interests. And that's a huge problem.
Right. So you're also saying, therefore, that companies are not doing enough in this regard, and maybe that this should be a warning signal or a alert that they should be focused more on these kind of dialogues. I mean, corporate sector as a whole.
Absolutely. Absolutely. And, we've had examples of where some of these dialogues have, for PR purposes, the private sector sometimes says that they're fostering this kind of dialogue, but really they've sort of handpicked a couple of worker representatives that aren't truly, representing the workers that are in those factories or in those companies. Also, Govind, a part of it is that there's a trend toward a growing precarity in the labor market, as I said earlier. You've got technology that's disrupting labor markets. You've got climate change and the energy transition that's creating upheaval. You've got inflation that affects the kinds of investment that's happening in companies. So, one day there's a lot of investment in, for example, platforms, and the next day this investment contracts and all of a sudden these companies are laying off workers. So all of this creates a lot of churn. And at the end of all of this churn are workers that are increasingly unprotected because labor regulations aren't applying to them because of the new kinds of work arrangements. And companies are, in many ways so afraid that they're going to be held responsible for not protecting workers adequately. And they're also trying to just handle this market volatility and cater to their bottom line profits, that it creates a really difficult, uncertain, toxic environment. And so in this environment, for everyone to kind of actually say, okay, what we really need is authentic dialogue where equal stakeholders, government, workers, and businesses come together and actually work out some of this growing labor market precarity is really important. And these protests only going to become, more and more prominent and more frequent.
Right. So you're saying that the government also needs to be a part of these discussions. And is that practical in terms of how industry would see it? And is there any other way to do it, or is that the only way?
Oh, absolutely. Government needs to be part of these conversations. In fact, businesses, private sector converse with government all the time, right? There's all kinds of conversations, lobbying going on when government's drafting regulation. So, and the government has a huge role to play in terms of drafting these laws, making sure there's even regulation and implementation of them. So they are the stakeholder of the biggest scale in this conversation. They absolutely need to be at the table, as do workers and obviously the employers themselves and the companies themselves. It needs to be a tripartite conversation.
Sabina, thank you so much for joining me.
Thanks so much for having me, Govind.
That was the Core Report with me, Govindraj Ethiraj. Do stay connected with more of our coverage at the Core. You can check out our website or sign up to our newsletter for our exclusive stories, one in-depth feature a day on www.thecore.in. Do also track us on LinkedIn, where we usually post synopses or extracts of our top stories and interviews. We would love your feedback on how we can make business more interesting and relevant, including, of course, India's vibrant manufacturing sector. So write to us at feedback@thecore.in, and thank you once again for listening.